Hello, and welcome to HCM's fourth quarter market update. My name is Doug Johnson. I'm the Senior Investment Strategist here at HCM. And today we wanted to go ahead and provide you with our most recent portfolio and market thinking. As a reminder, we will have a longer presentation available as well that goes into a little bit more detail. But this one is kind of the executive summary of what we're looking at right now. So without further ado, let's go ahead and take a look. On the equity side, HCM portfolios remain at our neutral targets. Basically, that means that we don't have an equity overweight or underweight, nor a fixed income overweight and underweight. Within our equity portions of portfolios, we do have an emphasis on high quality, large cap securities, and we've kind of made those shifts throughout this year, and we will probably continue to maintain those outside of any significant developments over the next few months. The reduction in rates by the Federal Reserve has certainly supported stock prices, but we feel like a more accommodative policy may be needed to regain or surpass previous highs. Now, just last week, we had an announcement of what's being termed as a quantitative easing light, so to speak. It's not quite the same as the programs that we've seen in the past, but nonetheless, it could be the first step in seeing that additional accommodative policy that may drive equities higher. But for the time being, we don't know that will be what is needed to regain all-time highs, so to speak. What we're seeing is defensive sectors continue to outperform as economic growth remains somewhat subdued. Outside of IT leading the sector performance year to date, you then have real estate, utilities, and consumer staples as the next three. Historically, when you have those more defensive sectors leading the way, it shows that the market's a little bit concerned about growth and the possibility for increased volatility, and I think that's been reflected a lot in the economic growth outlooks that we've seen. And then, lastly, tariff issues and a strong dollar continue to provide headwinds for international assets, which we remain with a slight underweight in portfolios. Again, on Friday, we had kind of a pseudo agreement, so to speak, that has subsequently been walked back slightly. There's been different assessments of what actually happened. But what we've been telling clients and what we continue to tell clients is until we see a solid deal that's been signed, we will continue to operate under the assumption that no deal has been reached. And that is going to continue to provide a little bit of an issue for our international holdings. So we do still have both developed and emerging market positions and portfolios, but those do remain underweight, and they will for the time being. So moving to the fixed income side, our most recent trade has been to increase portfolio duration as we've seen growth forecasts and economic data continue to deteriorate. Just as a quick refresher, duration is kind of a fancy way to describe the relationship between bond prices and interest rate moves. So as rates move up, bond prices go down and vice versa. So last year, we saw rates moving up for a majority of the year, and that caused us to add some shorter duration positions into portfolios to protect against that. We've since been selling off those shorter duration positions as rates have dropped, and now we've reached the point where we feel like those short duration positions no longer make sense in portfolios. So to kind of build on that, the reduction in short-term rates has lowered income levels for things like money market and short duration bonds, so that the income gap, so to speak, between shorter duration and longer duration bonds is starting to widen again. And lastly, index performance year to date for the bond market has been driven mostly by a huge drop in long-term rates. The 10-year Treasury was at 3.25% in October of last year, and it's all the way down to around 1.65, 1.7. So a good majority of the roughly 8% year-to-date return we've seen in the bond market has been solely a function of rates dropping. On the economic front, again, growth forecasts remain hampered by the uncertainty surrounding tariffs. We may get a little bit of a relief from this pseudo deal that we saw, but probably nothing substantial and nothing significant enough to kind of move off those forecasts. I would say U.S. recession concerns certainly remain. We saw what was a brief yield curve inversion over about a week's time, about 2 weeks, or I'm sorry, 2 months ago. And then we've also seen manufacturing output dropping below key levels. So that's, as we've seen hard data continue to deteriorate, it's certainly, brought that concern of recession to the forefront. We're still not seeing or calling for recession, but it's certainly at the front of our mind. Inflation remains, below the Fed's target of 2% and pretty much a non-issue at this point. Political issues will definitely begin to come into focus as the presidential election rhetoric begins to heat up. I think the assumption is that Trump will again be the Republican candidate. It's really on the Democratic side that the candidate kind of remains with. It seems like Elizabeth Warren, Joe Biden, and then Bernie Sanders as being the top three, with some rumors that Hillary Clinton may, in fact, run again. But until that comes into more focus, we're not certain that's going to affect the market quite yet. So what are the risks going forward? The three main ones would be slowing economic growth would actually accelerate in a recession. This would certainly cause a lot of volatility in the equity market and cause us to maybe, in fact, move in a more defensive position. Any escalation of negative rhetoric out of the U.S.-China negotiations would be a factor. We saw some positive stuff last week. Let's hope that can continue. And then lastly, anything unexpected out of the Federal Reserve in the direction of future policy. I think the expectation now is that rates will continue to fall or remain low. The Fed will be accommodative. I think anything that would come out of them that would be hawkish or would give the idea that rates would go up would certainly cause volatility to spike and probably cause some issues in both the equity and the fixed income markets. So again, that's our quick executive summary of kind of what we're seeing in the marketplace and how we have portfolio positions. Again, if you'd like some more detail or some additional charts, I would encourage you to take a look at the longer version of this presentation that we will have out shortly. But with that, I appreciate you taking the time for joining us today. I hope you found some value in this. And as always, if you have any questions or comments, please reach out to myself or your advisor.